Hi, I'm going to be showing you how to sell a cash secured put or sell a put, they both mean the same thing, on the Robinhood app. The stock we're going to be doing the example on is SoFi. So I'm going to click the search button at the top, type in SoFi, click on SoFi Technologies. Now when I'm selling a cash secured put, there are a few technicals I like to look at. So there's a button with a circle and two arrows within it. I'm going to click on that button. At the top, I'm going to scroll over to Bollinger, so the Bollinger Band. I'm going to click on that. I'm going to do 3 months out and click on the chart. We can see the lower Bollinger Band is at $6.71. A stock likes to trade within the Bollinger Band. So if the stock goes below that $6.71, it's going to tend to bounce back up into that Bollinger Band, so it's trading within it. So it's a good support for the stock. The other technicals I like to look at are the moving averages. I'm going to click on the 50-day moving average and the 200-day moving average. I'm going to click on the chart. We can see that the 50-day moving average is at $8.13 and the 200-day moving average is at $7.80. The moving averages are supports for the stock. So we can see that SoFi has broken both of those moving averages. This is known as a falling knife, and a lot of people will fall away or stay away from this stock because it's broken both of those support levels. The other technical I like to look at is RSI. The RSI shows if a stock has been oversold or if a stock has been overbought. If I click at the chart of the RSI, we could see that it's currently at 38. So for a cash secured put, anything between 30 and 40 is a good starting point. That means the lower the RSI, the more oversold a stock is. The higher the RSI, so like at a 60, the stock has been overbought. So for a cash secured put, anything between 30 and 40 is a good starting point. So to sell the cash secured put, I'm going to click trade options. A lot of people like to go the third week in a month because that's when institutions trade. I'm going to go to February 16th, which is about a month out from now. So to do a cash secured put, you're going to want to make sure it's on sell and it's on put. So again, you want to make sure it's sell and put. We can see that SoFi is currently at $7.57. The put we are looking to sell is at $6. So I'm going to go ahead and click on that. The information on this page I like to look at is the IV, or the implied volatility. Anything over 40 is good because that means you're going to get more premium or you're going to collect more money per contract. We can see it's at 97, so it satisfies that. The volume, we can see, is over 1,000. And for the volume, I like that over 100. So we can see that it's definitely over 100, so it satisfies that. And then for the Greeks, the delta I like to look at, or the Greek I like to look at, is the delta. We see that the delta is at 0.23. So if you take the inverse of that, that's the percentage of you winning the trade. So you have about, what would that be? A 77% chance of winning the trade. So if the delta was at 0.1, you'd have a 90% chance of winning the trade. So the lower the delta, the higher chance of you winning the trade or it not reaching $6. So it has a 77% chance of not reaching $6, or you can look at it has a 23% chance of reaching $6 by February 16th for the delta. So I'm going to go ahead and click sell. I'm going to do one contract for the example. Remember, one contract is 100 shares of SoFi. So I need $600 available to do one contract. Now, as a rule of thumb, if SoFi was a stock that I was thinking more long-term about, and I was looking at the $6 cash secured put, I would do a strategy of only doing 25% of how much I wanted to buy into the stock for the cash secured puts. So as a rule of thumb, if it's at $6 I'm looking at, I'd want to have about $6,000 in my account. Or if this cash secured put was $10, I'd want to have about $10,000 in my account to start out. And I'd only do 25% of that with the cash secured puts at once. So let's say for this stock, I had $6,000 available in my account and I was just starting my position in SoFi. Instead of doing one contract, I would do 3 contracts, because 3 contracts would be about 25% of $6,000. So 3 contracts of SoFi at $6, you can see there at the bottom, it's going to cost potentially $1,746. So I do these 3 contracts, wait until this contract either gets assigned to me or put on me or expires. And then I would go ahead and do another 3 contracts, because that's another 25%. And then for my last round, I would do 6 contracts. That would be 50%. And that would be $3,500. So basically, instead of just throwing all that $6,000 into SoFi, so instead of just doing 12 contracts at once at $6, it allows me to average down in the stock if SoFi just kept dropping and dropping and dropping. So it allows me to have a lower average by doing 25%, 25%, and then 50%. So 3 rounds of it. So for the example, we're going to do 1 contract. And then the next thing is a limit price. So we can see the bid ask is pretty close together. It's 18 cents for the bid and 19 cents for the ask. So we're going to go ahead and do 0.18, which they're going to pay $17.97 for doing this 1 contract. So for tying up $600, they're paying us $17.97. To do a quick percentage of what your return on investment's going to be, like I said, this is about a month out, we would be doing the $17.97. We would divide that into the 600, which would give us 0.029, and we would times that by 100. So that would give us 2.9% per month. And then if we wanted to see what our yearly ROI would be on this, it would be 35. We times that by 12, which would be 35.9%. So if we were to be able to do this trade continually throughout the year, we would be making about 36% of return on investment. So to continue with this, I'm going to go ahead and click review. I'm going to swipe up to submit it. And this is a weekend that I'm recording this, so it's going to put my order in queue since today is Saturday. And then just a couple other things. So to monitor a trade, I'm going to show you an example that I have with the 8.5 put that's going to expire February 2nd. So I'm going to click on that. We can see that SoFi is currently at $7.57. And so technically I'm losing on this trade. So to monitor your trade to see how likely it's going to get assigned to you or put on you, you could calculate the intrinsic value and the extrinsic value. So to calculate the intrinsic value, you're going to do the contract price, which is $8.50, minus the current stock price, which is $7.57. So of intrinsic value, this stock has 93 cents of intrinsic value. Now to calculate the extrinsic value, you're going to do the $1.27 minus the 93 cents, which is going to give you 34 cents of extrinsic value. So this is kind of the meat left on the bone of extrinsic value. So I still have 34 cents of extrinsic value, so it's unlikely that this trade is going to get assigned to me. So I'm not going to do anything with it right now, just allow time to continue to go on. and see if SoFi can move up before that expiration date. Now, let's say if I had only like 2 cents of extrinsic value, it would be more likely that this trade was going to get put on me early. And if that were the case, you could always roll your trade. So to roll the trade, you're going to click trade and roll position. Roll just means that you're going to basically close a position and you're going to reopen a new position. So if I wanted to roll this, if let's say this only had like 2 cents of extrinsic value on it, I would select a new position. So it's going to charge me $1.27. And I would want to look for something that was going to pay me more than $1.27. So if I went ahead and looked at the 23rd, at the 8.5 put, so if I kept my strike price the same but just extended the time on it, they're going to pay me $1.32. So they're going to basically bill me the $1.27 but pay me the $1.32. So I'm going to be making 5 cents per contract off of this. So like I said, everything's times 100. So I'm going to be making about $5 per contract by doing this. So if I wanted to extend my time, I'd go ahead and click roll. And what that's going to do is just give me more extrinsic value for my contract. So that's kind of how you manage your cash secured put and how you would roll it if you didn't want these shares to get put on you and you wanted to extend your time and make a little bit more money by rolling it.